Good day, good afternoon, good evening, wherever you are. Hey, welcome. We are here at Two Tokens podcast with DigiBytes and Anthony. Happy to have you here again.
It's a great pleasure to be here. Thank you.
We should do, what is it? We do it every 9 months, seems like. Huh?
It seems like that.
It's like
whenever he invites me.
Yeah. But it's good to talk about the state of the union, state of the tokenization, where we are, and how is your business going. And so,
that's so.
And thank you to have Jonny here again with...
we've just written a book with my colleague James Tiley in America, looking at funny money, looking at tokenization of the global economy, looking at programmable payments, looking at stable coins, all that sort of stuff. But Alex, we've known each other for nearly 10 years. Mm-hmm. We're here in sunny Switzerland, sunny Amsterdam, looking at tokenization of different asset classes. And initially people think tokenization, it's crypto. But delighted, Tony, joining us from TPX, and you've been very, very heavily involved in tokenization of real estate titles, and then also with your subsidiary company, London Digital Escrow, which is looking at once you've tokenized an asset, how do you hold those assets? How do you transfer value? But perhaps you can just tell the listeners a little bit about yourself and TPX, first of all.
Oh, my favorite subject. I get to talk about me now, do I?
Oh, no. That's all right. We can edit that bit out.
Okay, fair enough. So Anthony Abell, CEO, and one of the co-founders of the TPX Property Exchanges Group, of which we have a number of subsidiaries. One of those is London Digital Escrow. And that's what I'm coming to speak to everybody here in Amsterdam, mostly about today. So it's a quick refresh on TPX and what we're up to, and the exciting work that we're doing with our end-to-end solution and wallet technologies. But a quick refresh on the TPX side, of course. We've been getting set up to launch all our exchanges worldwide. We've been working as a top-down regulated approach to the marketplace, working with the Treasury, central banks, land registries, the legal profession quite extensively, and looking at a very simplistic level to make property titles, stress titles, a fully liquid transferable asset class that you could use commonly across payments.
So not using
systems.
Special purpose vehicles, not using funds.
Exactly. So we've gone to the root cause analysis, shall we say. We've gone to the roots of things. And we looked very much at how you take title, or in our case, micro title, of real estate sanctioned by the government, recognized by the government, recognized by the courts in each jurisdiction which we operate. And then how do you turn that into a form of transferable value, at its most simplistic form, that anybody in the world can use for anything, turning it into effectively a form of money, ostensibly without the banks, but with the government's permission.
Right. Because the real estate market is 393 trillion.
It depends how you want to count it. If you put the Chinese in there, it's a lot more than that. But you take a view on Chinese
But that's Savills numbers, I know. But
yeah.
But I was always intrigued. Alex, residential property, it's something like 65% of that number. So it's about 280 trillion is flats, homes, apartments, castles like you obviously live in.
You've seen the castle, yeah.
But Tony, so there's lots of people talking about tokenization of property. We've seen in many countries, depending on the jurisdiction, reverse mortgages or equity
Indeed.
release. There's a lot of people who are capital rich but income poor. Either they own the property and
Asset rich, cash poor. Yeah.
Yeah, but there's also an increasing number of younger people, whether you're in Amsterdam, Paris, New York, London, they can't afford to live in those capital cities because they've got income, but they haven't got enough capital to put down on a whether it's a $500,000 or €1 million, dollars, yen, Swiss franc, sterling.
Choose your currency.
They can't afford to live in those cities, so they're having to commute further in. But TPX is trying to solve both spectrums, the people that have got capital locked up in the property, but also those that want to get on the property ladder.
Indeed. I mean, when we modeled this out, and we've been at this for a while, we started with some of these ideas in 2016. We were part of the FCA Sandbox program in 2017. We've been building off of that base.
I've been following you forever.
So, yeah. The issue is always the number of lawyers that you have to employ to get the opinions, to get the government to do what you want them to do, which is in their best interest. But to address your point directly, when we built this, we built it with a larger view of how our economy should work and where value around real estate and how that should work. And within the real estate world, as many people who are listening to this will realize, is that you have the banks, you have mortgages, you have credit creation, all of these players within the system, all the banks, the financial institutions, the conveyancers, the land registries, all have a role to play. But fundamentally, if you understand what each wants to get out of that process, the very, very exciting thing is it changes the nature of the asset, not in terms of what it does, but how it's used. And you can give everybody in that value system exactly what they're looking for. To address your point precisely, it allows, from our modeling and from everything that we've been building, it allows the young to buy their home at 51% of the previous asking price of the property without having to have a mortgage for the balance. Why? You might ask yourself. It's because we realize the balance, the 49% in this model, is far more valuable a financial economic system than it is to the homeowner. But the homeowner was penalized by having to pay for their use of effectively part of their home. And when there's a down economy, bad things happen, not good outcomes, homes get lost because people can't keep up with their payments. So why not restructure things? Why not treat those title certificates for what they are? Tier 1, ostensibly AAA, high quality liquid assets that quite honestly the banks and financial institutions covet on their balance sheets because they can leverage that for the money creation game that they're all involved with. And that helps them in their business models. But why should the owner of the property be penalized and not get an interest for the money that they make off of that house, their house?
Because the banks make money off of our back.
Yes, but they don't prefer they really don't prefer you know too much about that, because if you found out how much they're actually making on your home without telling you, for which you paid for each month and they shared nothing with you, you might reconsider taking a mortgage in the future. And that's exactly our point. So we're looking at the entire value change and turning the spyglass around the other way and saying, well, hang on a second. If you own the property, you can take those title certificates and put them in the right place in our financial economic system. And then you as an individual or as an institution can earn the interest or the yield that those property certificates can generate as they go through the system. So it's no longer exclusive to the bank's property, so to speak, or the bank's distribution. Now you can actually say, well, hang on a second, that's my property. You're making a lot of money off of me. Now share that with me.
So two questions come to mind. One, of course, the laws in each country are different, right? So I'm sure that British common law is going to be easier than what Napoleon did to us here on the continent.
Yes.
Right? That's a question I have there. And the second question is, if I recall, the 2008 bank crisis was all evolved around the whole housing, the complicated financial
savings and loans crisis.
Yeah. Well, it started with all these complicated structured loans on homes, right?
Yeah.
So what happens if some of those loans that are with the banks and everything, now all of a sudden parts of them are tokenized? That could make it even more complicated. Or am I just making it more difficult in my mind?
Yes and no. I mean, when we looked at 2008, the CDO, Freddie Mac, Fannie Mae, all of the crises that happened from basically stacking up too much debt on the property.
That's right. Yeah.
And the system collapsed under the weight of those. And they were selling mortgages to people who patently had no opportunity whatsoever to be able to pay them. And that ended up with a lot of bad things happening, a lot of houses being seized, a lot of suffering for a lot of people, I might add. If you run a transparent system, our blockchain technologies, they allow a degree of transparency, governance, and ultimately trust in the system, what I would argue could eclipse the existing legacy banks, which can be a little opaque at times. Mm-hmm. So fundamentally, our technologies and our artificial intelligence, our agentic AIs, are allowing us to produce much better safeguards. All right, now in our model, there is no hypothecation. There's no lien or charges on the title assets created in our system. Once it comes through our exchange, the mortgages are taken away. So we always look for properties that have a loan to value of less than 49%. They get paid off and settled. All right, so the asset comes to us clean. And that's very important. And the purpose of our exchanges, our TPX exchanges, is to maintain that transparency, maintain that value, maintain that trust. And we're insured for that. And so therefore, as the title certificates make their way through our exchanges around the world, whatever function they may pursue, We don't do this by hypothecation, loans, liens, charges, or liabilities. We do this by repurchase agreements. So it's very clean, it's very linear. You either own it or you don't own it.
Okay, and then you can list it on your...
And you can list it on our exchange. And that's very important because at a very simplistic level, if you're buying your new car with title certificates in our world, or a version of it that we've created for speed and efficiency, you want to make sure that there's no other charge on the instrument that you're being paid with. Mm-hmm. So you have to make sure it's clean. Otherwise, you can't use it as money. Don't forget, our entire model is, our focus is, although we have exchange in our name, fundamentally, we don't make much money on our exchanges. We make money when people pay for goods and services using the title certificates that we created globally. And we think we can do 10 or 20 or even 60 times what an exchange can do based upon the use of our title certificates in the global payment and settlement systems.
Okay. And Tony, the question in terms of sort of different jurisdictions and different laws. So you mentioned Napoleonic law on the continent and English common law, which is used through a lot of the Commonwealth countries and in other countries such as America. So how are you dealing? I believe you have a series of different exchanges in different jurisdictions.
Sure. So it's 20 exchanges worldwide that were launched or launching at the moment. Fundamentally, each of those is bespoke to each jurisdiction. So we sit down with the appropriate regulators, with the real estate industry, because we're working with them, with the local banks, financial institutions, and those that are close to them. And from our modeling and everything we've seen so far, we're about 85% consistent. 15% is bespoke to the local laws associated with real estate, particularly. The nice thing about much of what we do is that buying and selling of title of real estate is, in all the jurisdictions where we're looking to launch currently, is not a regulated activity. And we sat down with our regulators in the various jurisdictions.
So you mean just trading a title is non-regulated? You don't have to go to a notary, or you don't...
Yes and no. So in English common law, going back to your point, that castle that Jonny mentioned that you live in.
Yeah.
Sandcastle, Alex.
Sandcastle, yeah.
If you sell it to me and I sell it to you, or vice versa, in any variation, person to person, peer to peer, it's not a regulated activity. Real estate agents are not regulated by your financial authorities, the SEC.
But the title is registered in a...
Indeed. And within English common law, it's a bit easier because most of those, it's a rather compelling point here. Those land registries are a clearinghouse ostensibly for the banks.
Yeah.
They are not the final proof of ownership. That is for a court to decide. They're a registry. And in the United Kingdom, fully 1/3 of the land in the United Kingdom has never been registered on the land registry.
Really?
And really, land registry is there as a
third
tax collection.
It's tax collection and transparency for the banks. Yeah. So the banks don't want to be putting a mortgage up for somebody else who's already had 7 mortgages on the property. So they need to have a registration system. But to be clear, we sat down with our land registry, and it's very fundamental to our model that we have a working model. We think we're producing a better land registry than they currently can run because our treasury doesn't give them a lot of money to create new things. So for the properties that are on our exchanges, we have a higher level of transparency, systems and processes to stop bad things from happening than the land registry in the United Kingdom can currently afford. And that's how technology should work. So the commercial sector.
So after 20 exchanges you're doing worldwide, I would imagine 18 of those are in British common law.
Mostly, yes. Yeah. Now we are dealing with some legal firms that have had some conversations with legal firms here in the Netherlands. We're very interested in that one. There are rules by which you can have common ownership of assets. I think they call it the law of association. And that allows us, we believe, to do much of what we want to do here as well. And the Netherlands is a very attractive place for us because you have very strong property laws here. And that's a fundamental piece of making sure that our system runs coherently and safely for everybody involved in it. So we're very interested in the Netherlands. We've had a couple of conversations with potential launch teams here and individuals within that. We haven't yet set who we're going to be working with, but we intend to identify a launch team here as well.
What about Spain?
Spain as well. All of the European countries. We're a little nervous with the French. They like every few hundred years to cut everyone's heads off and seize everything. So we're trying to avoid that a little bit. But the French, ultimately, should we find a launch team in France who are brave enough to deal with the French tax authorities, then we're more than happy to provide a license for them.
And Tony, before we go, could you just give us a brief overview of London Digital Escrow, and just for the avoidance of just disclosure or anything, I've been helping yourself and your partner David with both TPX and also with London Digital Escrow, where I am a director. But getting that sort of disclaimer, I suppose, on
Yes.
the table. But perhaps can you just very briefly explain what a London Digital Escrow, what's the problem it's solving, and how's it going?
I mean, London Digital Escrow, the main reason I'm here today in Amsterdam was to brief people on what is happening in this part and the two tokens community. London Digital Escrow enables the end-to-end transaction for goods, services, and assets using a military-grade, safe, and secure self-custody digital asset wallet. So we're applying technology to a process which is endemically full of challenges and hassles. We all know the stories. Things are lost. Sometimes even the lawyers help themselves to some of the digital assets that are passing under their noses. And so you have to create a system just like the US military did, which is permission action link. What it means is that you can encapsulate the private keys, which are the things that are at risk, the things that disappear. And that's how problems happen, is when someone gets hold of the private keys. But if the private keys are encapsulated in a device, ostensibly, that can only unlock or lock depending upon the message it received, but you can never see the private key and you can never move the private key anywhere else without that physical device, then you create a level of security, just like the American nuclear weapons, F-35 jets, Predator drones, which all use the same technology that we have here, that we've created, that we've got an exclusive license to. Then it stops the private keys from, quite honestly, getting stolen or nicked, as the English would say. And it's very important. Now, for lawyers, this is fundamental because when they have their clients are pushing them constantly to be able to do digital asset transactions. We have, to my knowledge, about 12 legal firms in London that are engaging with us in various levels that are looking to use our wallet technology so that their clients can transact in digital assets securely while massively reducing their insurance premiums for handling those same digital assets. So the system that we've put in, which I'll be talking to everyone about today, is very carefully organized so that every component piece and every component person within a transaction has no ability whatsoever to move off or remove any of those digital assets.
Wow.
Right? And they're being transparent. Everybody can see what's happening. When someone doesn't do what they're supposed to do quickly enough, everybody sees it through a common dashboard.
Yeah.
And it means that we can reduce the time for a transaction to happen from weeks or months to theoretically days and hours. And that's a huge thing. And just to give you some numbers, some of the legal firms that we're dealing with are doing over 300 million pounds sterling a year in digital asset transactions, in this case, mostly for real estate. And fundamentally, we see much of them doing it. So for us, it's a rich vein. There's some good news here for the lawyers out there. I'm just going to add this, because part of this process is we also identified it's key that the legal profession is still involved in this. You can't just willy-nilly do this. We still need our lawyers, folks. And fundamentally, one of the things we've crafted here, and we're talking to the Solicitors Regulation Authority in the United Kingdom, is that you still need a human oracle, AI, agentic AI, these sort of things. The lawyer still has a role. And the headline numbers on this one is based on some of our analysis. We think there's about 10 million billable hours for the lawyers in the United Kingdom if they're operating as human oracles, supporting not just us, but agentic AI type activities. So good news for the lawyers here. Bad news for the rest of us. We can't quite get rid of them. They're an integral part of the entire process.
But Alex, I think on that point, it's really interesting, because I think this is where the EU arguably has been leading, because under the EU AI Act, it's basically saying they call it high risk. So basically high value transactions. They're saying you've got to have a human in the loop. You just can't have a free for all whereby money's just being moved around. We don't know. And if you take a figure of, say, 10,000 euros, typically you're going to have to carry out KYC and AML. So what you want to do is get the architecture, get the plumbing sorted out. The lawyer then identifies the buyer, the seller, and make sure there's an audit of where the money's come from, where it's going to go, and why. And then the lawyer kind of steps back, if you like. They lift up the gate, and they can say to the buyer and seller, right, now you can proceed to do that transaction.
So it's going to become more important even. One of our sessions, we spent a lot of time on zero human companies.
Yep.
And 6 months ago, nobody knew what that was. And now in worldwide, we have over 10,000, I'm told. Some of them, of course, are experimental. but that they are exactly what they say they are. Right? There's no humans involved to do trade payments. Yesterday it was in the news that ING and MasterCard and some other player, are now doing the first agentic AI payments, with no humans involved. Yep. So it's going to be interesting to see, when humans are in the loop or on the loop, what as to your point, how this is going to pan out. So you have something here, I would say.
Indeed. I mean, it's a very topical conversation. We spent an enormous amount of time looking at and developing, as part of our wallet technology and the LDE approach that we have to this, an agentic AI family office. Now, we're not here to talk about that today, but the agentic AI effectively is now at a level where we're talking to it. We have a deployment in the US, an alpha deployment with some customers. And in that deployment, you talk to your AI. You don't need to write anything down. You don't need to send any emails. You don't send any text message or authorization codes or any of that. You just talk to your AI. Yeah. And the AI enables a transaction.
But there are some legal issues with that, right? Because, every company officially needs an address. You need a postal address. You need a registrar. Now you can do that, but you need to have an ultimate beneficiary of it, a UBO. Yep. Right. Yep. So all those, that's defined by law. So how can we have zero human companies and bypassing all those steps? So,
well, I mean, I don't want to take the conversation too much into space, but there is a very valid point here, because when Elon finally gets his server farms up in the space where all the energy is, and you can run it AI almost ad infinitum, who do you serve your subpoena on?
Exactly. Yeah.
If the company is an agentic AI company with an address in outer space.
In space, yeah.
So, there's some real
maybe Mr. Musk's going to get a lot of writs being filed saying, hang on, we need to track that man down. But Tony, I'm very mindful. Thank you very much for coming. If people would like more information, how's the best bet to get more information about TPX and LDE? Yeah,
just reach to us. I mean, 2 Tokens obviously has our contact details. To give you a website, www.tpx-global.com is a point of contact. Reach out to us there. We're happy to engage with people. We're happy to brief the market as we go.
And London Digital Exchange?
London Digital Escrow, it's HTTPS : // London Digital Escrow as one word .com.
Or you could just ask your agentic AI to take you there, and you don't.
Indeed,
you don't have to do the HTTPS.
All right. Well, look. Thank you for listening to the podcast. We'll be back with another episode shortly. And take care. Thanks, Alex. Thanks, Tony.
Thank you.
That was it for today's podcast. Thank you for listening in, and please subscribe so you don't miss out on our upcoming episodes. If you want to get in touch with us, you can find our contact details at www.2tokens.org.